Welcome back to The Contrarian, everybody. I'm Logan. Today I'll be talking about why I think it's pretty decisive that the banking crisis is not over yet. Now, I'll be looking at two primary charts for this that indicate that there's a lot of issues to come, that what Janet Yellen is saying, what Jerome Powell are hoping with regards to the banking crisis being contained within just a handful of banks, that is really not going to be the case. And it's more for more structural reasons than what they might be looking at. So I'll dive into it right now. Now, the first chart I'm going to take a look at is very, very significant. It's essentially saying that your average consumer, your average depositor in banks, which is most adults, let's be honest, is most adults, have their deposits in some sort of commercial bank. It's probably a big bank, but these depositors are withdrawing their money in record amounts. So we're actually getting down to the largest outflow of deposits from commercial banks since 1981. And as you can see, that goes way below what even people were doing during the panic in the 2007 to 2009 type era when banks were going under. So it is very telling that your average bank depositor does not have trust in the US banking system. And it does kind of show why the media, why Powell and Yellen are trying so hard to restore confidence as much as they can, even if it be through maybe not as conventional or actual factual type data that they present. It's more so out of desperation that they need to restore confidence. Because when you get these kinds of outflows, it becomes very difficult for even a healthy bank to function as it begins to have to sell assets to gain more capital, to repay depositors. It can turn into a vicious cycle. And so bank runs very much could be an issue going forward. But there's an even bigger issue that we'll take a look at right now. And Nick Jurley pointed this out a few weeks ago on Twitter, and it's still very much in play right now. If in fact it's likely gone further along this trend line since he posted it, but he posted just the obvious thing that the M2 money supply is contracting for the first time in almost 100 years. And this is a big deal because when it contracted this significantly last time, when it went below a negative 2% where we are now, that was when the Great Depression occurred. So that's a really bad sign. Also, again, in 2008, in 2000, in the 1990s, pick whatever recessionary period you want to go to. We never got into negative territory even then. And so in the last year, the M2 money supply has contracted very, very dramatically. We went from extreme over-the-top growth in money supply during the COVID response. The Fed went monetary bazooka, kept interest rates very, very low, and so that led to an extreme growth in credit, which essentially M2 is taking into account the growth in credit, the availability of credit, and the overall economic activity. So M2 includes more than just a M1 in terms of savings account, checking account, deposit type things. It also includes credit availability. And this is very telling because it does show that the Fed went way overboard in terms of the tightening cycle that they did last year, went way too quickly, and yeah, it does show that the Fed was not maybe taking into account the degree to which raising rates on an extremely indebted and over-leveraged economy would have. And like it or not, the U.S. economy is so dependent. I mean, it is the lifeblood of the U.S. economy is credit availability. And when credit availability goes down this dramatically, all of a sudden you have economic activity slow down dramatically as well. So you have the inability of home builders to finance building a new projects, inability of buyers to buy the homes, inability of businesses to take out loans to grow their businesses, or in the case of zombie companies, which, like it or not, zombie companies make up a lot of the U.S. economy as well, you have the inability of them to continue going, and so they go under. And that results in high unemployment, severe recession, if not depression type situations. And it does just indicate that the banking crisis is a lot more structurally related. It's not a select few banks that were way over leveraged as we might have initially thought, because these were the banks that first were affected, that first went under, because yes, they were the most weak to begin with. But it could be the situation where you start having even large commercial banks have issues, not only because of the capital outflows like we saw previously, where people are losing confidence, pulling their cash out of the banks, but you could also have issues where, say, a Wells Fargo has, treasury bonds that are also way underwater, and they're having to sell them at a loss. And you could have the kind of Silicon Valley Bank type issue, even with a large commercial bank. Now, I hope it doesn't get that bad, obviously, but it very well could be, just looking at these two trends here. And so it's kind of for these two reasons that I am not on the bandwagon that the banking crisis is over. And in fact, I would be more inclined to say that it's just starting now. It's just the beginning of this trend. An important, I guess, takeaway is do what you want to with this. Act on this as you will. I'm not going to say a particular thing would be good to do. Yeah, I'm just going to leave it at that. I do try to be optimistic, but when data indicates otherwise, I try to follow the data and where it's going. So unfortunately, in the last few years, that has led to some fairly more pessimistic type statements, also some optimistic ones, but yeah, I don't try to be pessimistic by nature. I really don't. But I hope this video was helpful for all of you in terms of trying to think through this question of the banking crisis and issues with banks. And if you liked the video, give it a thumbs up. If you didn't like it, give it a thumbs down. And I hope to see all of you again at some point.